Hello traders, let's talk about dealing ranges today. This is Mel with High Speed Trading Company, and this is lesson 3 in the High Speed Trading Academy. We're going to talk about dealing ranges and how they will help you immensely within your trading. It gives you a better understanding of the areas to start looking at to go long and to go short. So with that, let's get started. Our objectives today are to understand what a dealing range is. And it's going to be a pretty simple concept, but it's a very, very important concept. We're going to identify where dealing ranges are and why the dealing range is critical to your trading. So a really simple diagram to start off with is we have two areas, premium and discount. The area in between, or the line in between, is equilibrium. Above that is premium. That's the best places to be selling when you're wanting to go short. And the discount is below, is where you want to be buying when you want to go long, when you're taking a long position. If we look at this diagram, we have a line here and it goes up. Let's just assume this is our chart. The chart goes up, makes a high, comes down here, makes a low, comes up and makes a lower high, and then goes down. So in this diagram right here, if we were to look at this high and draw a fib, and we'll show you how to do this once we get to the charts, down to this low, and if we were to look at the 50% of that, that would be equilibrium, that would be right there. And what we expect is the market to come up into that equilibrium, to go into a premium, sometimes very, very shortly. And this will be a good thing for you to look back on your charts and to practice this. And you will notice that sometimes it'll go into a premium and it'll just kind of hang out. Other times it'll just pop into that and come right back out. Just a concept to start thinking about and noting when you're looking at that is time. What time of the day did that go into premium, and based on the time, did it stick around there or did it just collapse out of there? In this case, being bearish. So let's go to the charts. Let's take a look at a couple of examples. Here's one example right here. And we have a bearish market. Market's coming down, going up, coming down, retracing back up, and retraces, comes down a little bit, and then retraces back up again, and then goes down. So if we were to, let's just get rid of this for now, and we were to go to our fib tool, which is over here, and it says fib retracement. Click on that, and we're going to put it on that high, and go down to the low. And I have this template saved. If I were to double click on this, I can go down here to template and I can change how I want that fib projection to look. There we have projections. We'll get into these as we use them. But right now we're looking at premium, discount. We're looking at the dealing range. And so I have that saved as a 0, a 1, and a 0.5. And so on this range right here, from this high to this low, we create a dealing range. The institutional smart money is going to seek to go, sell when the market is in a discount, when a market is in a premium. Bullish price seeks discount before a move up. A bearish price seeks premium before a move down. Institutional money wants to get the best price they can so that they can then maximize their profits. Very simply, you will see many times where price will come up into a discount or into a premium on a bearish market, into a premium, back down. And in this case, we have basically, if we were to look at this, we would call this this is a sweep. And so we're gonna right there. When I do that, that annotates a sweep. And so we have a sweep, which means they're taking a stop hunt, which we'll talk about later in a later lesson. But after it takes a stop hunt in a premium, the market then goes into a discount and then actually goes below this lower low. So let's look at the chart some more. And so here we have the NASDAQ. And this was a larger time frame chart. Something to know, to realize is that we may find a discount in a higher time frame, but we can also find smaller, I'm sorry, not discounts, but a dealing range. We can find a dealing range on a higher time frame, and it's not uncommon to find smaller dealing ranges within that dealing range. So let's go to the fib tool again, and I'm going to go down here, and I'm going to go to this low right here. And why am I choosing that low? Because that's where we begin to see the aggressive price up, and we're going to go up to this high right here. Now, of course, we have the advantage of hindsight, right? If I was watching this in real time, let's say that I'm watching this in real time, and it goes here. That's going to be my dealing range. So as it goes on, it goes up, and we can take that dealing range and move up to the newer high. So now watch what price does. There it goes. We're bullish. Market structure is higher. We created the dealing range. We came back down into discount, and now we're moving back up. Now let's look at something here. So here we have dealing range into a discount. If you were to put another fib on this from this point to that point right there, you can see that price comes down, back up, and this is interesting. See that it comes back up into this would be we would see this more significantly on a lower time frame, but back into a premium, then back down, and then basically we end up coming down into that again here, and then taking off. So these can play on each other. It's important to understand, it's important to know. The best thing that you can do is to go into your charts and look for examples of this. So let's look for just a couple more examples that really drive home the point. These can be a lot clearer when you have, this is a if you look at this right here, look at this right here, we have basically consolidation. See that? We're just consolidating. And that is, gosh, that's about a month and a half of consolidation right there. This is a 4-hour chart. But if we were to come back here where we have, that's where we looked at before right there. But if we come back down into this, let's do this. Let's drop down to a 5-minute chart. Okay, there's a 5-minute chart. And this is Friday. This is end of day, or here it's there's the start, there's the open right about there. And look at this. We're definitely looking at this market. We're definitely bearish. I'm going to mark this. This is a 5-minute chart, and so there's our New York Open right there. So if I were to come in here and put a fib at that that high after the open, and then down here, what do we see? Market comes down, retraces into a discount, and then goes down again, over and over again. Let's back this up and give you even a better example. Let's replay it to right here. Let's get rid of that line. That's our open. We'll just keep that, and we'll just mark that as the New York Open. Okay. So the New York Open happens. Oops, up. That's not what I wanted to happen. Hold on. Let's back this thing up. That went way too fast. Okay, we'll just do this click at a time. What I did again. You don't have to be a rocket scientist to trade. Okay, there we are. New York Open, 5-minute chart, the NASDAQ. And so there we go. We have here, what do we have? We have a lower low, right? Yeah, let's get rid of that. We have a lower low. So we have, in essence, and by the way, the dealing range doesn't always, sometimes dealing range appears to not work, but sometimes you just need to look at the bigger picture. And what I mean by the bigger picture is, you may see, well, that didn't work, but then if you were to look at a different time frame, you'd go, oh, there is, this dealing range was satisfied. It went into a premium on a lower time frame, or even a higher time frame, and that allowed them to buy at a premium before they took it down. So let's look at a couple more. So right there, so we have a dealing range right here. It looks like we didn't get up into that premium, but let's look at this. And now what we have here, in essence, we have another dealing range. We have another range we can look at. Okay. And again, what are we looking for? We're believing this market to be bearish. And so what did that market do? Right there, we created the dealing range. Right there, we went back into premium. Let's kind of explode this just a little bit, and you can get a better picture of this. See this? There's our dealing range from there to there. Let's get rid of this one. From here, this high, to this low, and then we went back up into a premium and then quickly broke down. So, and again into the premium again. It gives the smart money opportunities to go short right there. Okay. So let's do one other thing here. just to illustrate what we're doing, we're going to go drop down to a 1 minute chart. And I lost my dealing range. Okay, there's Y. There's my dealing range. Here's what we were looking at. Here's where it created that dealing range from there to there. So you could, we went up into that, and you could actually, what I would probably do is I would move that down there after that's created. You see that? Up into a premium, stabs up there 3 or 4 times, then breaks down. Okay? And you can just look at this over and over and over. Sometimes it's very, very obvious. Sometimes it's not as obvious. And sometimes picking the right dealing range can be a little bit tough. And again, it doesn't have to go just barely over. Sometimes it's going to go way up. Look here. Look at this right here. See how it just stabs up there just a few ticks and then breaks down? That tells me that this market is wanting to be bearish. So that's where we are. So anyway, so breaks up in there, comes back up, and then does it again and breaks down. And we could just continue to do this. Just do this someday. Just get in here and look at the charts and just play with dealing ranges. See this? Little dealing range right here. Comes back up, bang, goes into premium, back down. You're going to see this over and over and over again right here. Did we already look at this one? Into it, back down, into it, back down. I would probably move that to there. And anyway, over and over again. That, by the way, 10 o'clock, just for a teaser for our fair value gap. This is a silver bullet play right here. Let's expand that, and I'll just give you this little teaser for later. So we have this fair value gap, which we created here. And look at this. This was Friday. I took a trade here, and I wrote it down to here. I got out right there. But it did come back up and go back down. But if you look at time, 2 times we want to be aware of on the silver bullet. 10 o'clock, 9:30. So there's the open. We get manipulation up. We get a big move down. So just a teaser for later on. This is a fair value gap. After 10 o'clock, the silver bullet happens between 10 and 11 o'clock, ideally. There we go, 10 o'clock. And what else did we do here? We took out a sweep right there. We see that. We swept these highs, which means there's a stop hunt here. Come up, stop hunt, take them out, come down, create displacement, which then we create a fair value gap. And again, I find that very interesting. Some of this stuff, it never ceases to amaze me. Is if anybody says there's no such thing as an algorithm, then they're not paying attention. See this? We create a dealing range right there within that. And what do? Back up into a premium before it drops. Okay. And how far did it drop? See that? That's a nice trade right there. I believe if you go to the 15-minute chart, there is, we'll just put a line on here and then we're going to be done for the day. So if you look at this again, this is a 15-minute chart. Let's go back to the 1 minute. There you go, fair value gap. Enter on the fair value gap. Right there. Give yourself about, let's just put her at 80. Just put her right above that. About 65 tick down to this line, which we know that's liquidity down there. That's almost a 9 times risk profit. That's a 9R trade right there. Anyway, until next time, I hope you learned. Oh my gosh, I went over, extremely over, 10 minutes. Anyway, I hope you got something out of this. And until we talk again, be blessed.